Hi, and welcome back to Strategy FOREX. In this series, we are looking at how to make our entry very much precise and selective when trading. So, first of all, we say the condition number one is when you open your chart, you go to your higher time frame. And the higher time frame we are referring to is either your H4 or your daily time frame. So when you get your higher time frame, is that you mark out your area of support and resistance, supply and demand zones, your point of failure, your point of reactions. Now, what we refer to as point of failure is this. Looking critically at this particular bullish candle, this candle that went up here, that candle went from this point, this bullish candle, which become a pin bar, went all the way to this upside, attempting to push price to the upside. Then unfortunately, the candle failed to take price to the upside. So from the beginning of this week to where the week ends and then the body close is what we refer to as point of failure. So where the candle close, the wick from that point to the up, this place is a point of failure. And that is why you see I use my horizontal line to mark out the end of that wick. That is point of failure. So now where you have the body and then close and subsequent candle that form to reverse the price is what we refer to as point of reaction. Okay, so here you can see this point that there are candles here and price reverse. All this is point of reactions. Okay, so that is what we refer to as point of reaction. This is point of reaction, where you see the reactions of the other opposite market participant. Sellers react and turn the price to the downside, while buyers failed to take price to the upside. So this is failure of the buyers, which indicate by the wick, by this rejection candle, signify the failure of the buyer, while the reversal of the price from this point to the downside shows the reactions of the sellers and their presence in the market. So you mark out your point of failure and your point of reactions, and that is exactly what I am doing. Now, what you are marking must be a significant zones. Okay, you don't need to come, for instance, to this point and mark this one here. That is not what we are marking. It must be a significant zone. You can see here had been marked previously, and look at when price came in, you can see that price returned from that point. So it must be a significant point of reactions where you see real price movement, because you must bear in mind that you are not the only person viewing the market. Neither are you the only person participating. So what you should be marking should be obvious. Let it be where and what every other person is seeing. Okay, because only you cannot move market. You are only joining the market participant to move the market in the direction. So you are looking for where there are institutional movement for you to mark, not where there are retail market movement. And you can see only institution can move price this way. And one of the things you used to know is you will see that even in between here there is a fair value gap. Okay, this move to this upside, there is a fair value gap here. This is a fair value gap, and then in between this move after to this downside, there is a fair value gap here. So this shows that institutions are the ones moving price in this direction. You see this strong bullish candle? This is an institutional candle. So this is how you mark. That is why some of the zones you mark before now fails, because it did not depict the institutional movement of the market. So you are marking the zones where institutions move. So having said that, you have marked out your area of support and resistance. Now you mark out your trend line as well. So here is my trend line critically marked out. Now I've marked out my trend line. Without being told, you can see that price has been moving under this trend line, which shows that I am in a downtrend. And also, price is below my middle Bollinger Band, which shows a double confirmation for me that I am in a downtrend. And the next thing is that I will move to my H1 time frame. Now this is my H1 time frame. So I'll be waiting for price to come to one of these zones so that I can make an entry. Remember, we said we have basically two conditions. If we were to make entry for the trading hour for a reversal, just like this reversal that begins from this point, we are trading M and W chart pattern. And basically we have three types of M pattern. We have the M pattern that is a perfect M formation. We have another M that the first leg is longer than the second leg. I will have another M that the first leg is shorter and then the third leg is longer than this. So in most cases, this type of M gives a divergence. So in this scenario, this price movement, look at the M pattern that moved this price. Price went up, it came down, went this way and moved to the downside. So this is the M with the first leg is longer than the second leg. So the best way now you make an entry with this M is this. Look at price move to this upside. Give us a rejection of a pin bar. You can see this pin bar that is formed. So this came down. This is your first leg of the M. So you are waiting for the second leg of the M. And look at what happened. Price went to the upside again. So when these particular ones happen, that is when, because you know, one, this thing happened at outside your upper Bollinger Band, which signifies an exhaustion point. And I already told us in the previous video that whenever price left this upper Bollinger Band, price will begin to move towards the middle Bollinger Band. And if price break through the middle Bollinger Band, the next target is the lower Bollinger Band. So immediately price give you this pin bar. If it is a pin bar you cite, or it is an engulfing candle you cite, you will highlight it the same way I highlighted that candle. You can see that markup. After I've made this markup, I will be waiting. See now, then price begin to move to the upside again, and as price is going to the upside again, I will pick my trend line. I will mark it up this way. So immediately I mark it up, price reverse, break towards it. You can see this candle give me an engulfing, and then I have this candle that close below my moving average 10 and 25, this particular candle. So immediately I cite this particular candle, I will pick up my trend line and connect my trend line from this other previous candle to this candle, just as you can see this trend line. Simple. Pick my trend line and I connect it this way, and I have this. So at the close of this candle, I have my sell entry here and my stop loss is here. This is my M formation. I believe this has been explained in detail. So if I have missed this particular entry, I'll be looking forward for a continuation trade, and I'll be spotting this continuation trade using my bullish engulfing candle or my pin bar. So here are my continuation trade. I have one here. This is an engulfing candlestick pattern. This particular candle, that is my engulfing candle, bearish engulfing. There is a rejection, then followed by bearish engulfing. I'll make my entry. My stop loss is up there. Here I have a pin bar. This is a pin bar which becomes my second entry. For you to have a sell entry, which is a 4 o'clock trade, every sell entry is a 4 o'clock trade. For you to have a 4 o'clock trades, your moving averages will be above your candlesticks formation, and that is exactly what you are seeing. So this is another candlestick formation, and this entry, first and second entry, third entry. Okay, here again is my engulfing candlestick, another entry, stop loss above. Now when you get a double pin bar, it becomes a double confirmation, and as I am making this entry, I will readjust my trend line exactly how you see it. Price break through my trend line, I will exit this trade. Remember, there is a support here before, so at price approaching this support, we should be expecting a reaction. So even if I get any entry signal in this zone, I won't take the trade at all for any reason. So now price has come to this support, and here we have a W chart pattern. Price came, went up, and moved this way. Now in this W chart pattern formation, you can see this perfect movement of price. Price came, gave us a bullish, went up, and then it came the second time to give us this pin bar. So this pin bar rejection, when this happened and price went up, all you need to do is you mark out this particular candle. Mark it out this way. Can see? You mark it out. So you are expecting price to come back, return from inside. And you can see your trend line is still there, right? So price came in, tap into it, give you this pin bar. So you can choose to make your entry at the close of this pin bar. Your stop loss is below. And even if you did not, here we have an engulfing candlestick pattern. This is an engulfing. You make your entry. After that engulfing, you can see that we have another pin bar confirmation. Make your entry, stop loss below. That is your W chart pattern. And then price move a while, and immediately this begin, you pick up your reference line and you connect your reference line this way. Remember, you still have a resistance ahead of you. So when you see price behaving this way, there is every tendency that price will return. And even if this should take you out, you have made enough profit from your first movement, despite you know that your overall movement is a sell. And then you see that price went, break that support, the support become a resistance and retest it. And now we continue to the downside with our new entries. And here you can see this rejection, this particular candle, this is a pin bar. forget about this week. This is not a doji, this is a pin bar, because the doji is not at the half of the candle. So this is your entry, and then double rejection, double confirmation. Then you take another L there, and you can see how you will be in this particular trade. Okay, so now in this scenario, you can see that price has come. Now most of this M and W pattern, 80% of it, which is a reversal, is formed around the upper Bollinger Band and lower Bollinger Band, because it shows us area of exhaustion, but we need price action. So this zone now, look at what is happening. We are having our M formation, price came, price went to, this is a W formation, I beg your pardon. So we are expecting the second leg of the W to go up. So what do we do now? We will follow it carefully, mark out this zone, okay, which is the first leg formation candle. So there's a tendency, remember, that it can go below the first leg, because we say we have 3 types of W pattern. So it can form this particular W, which it will come down, come up, okay, which the first leg is longer, the second leg is longer than the first leg. So it can sweep this liquidity before it will go to the upside. But already we have it marked out, and we are waiting for what candlestick formation this will give us. If it give us a pin bar or an engulfing candle, then we will decide on what exactly to do at this point. And then we'll have our trend line. So let's wait to see the outcome of this movement. So this is how you can take advantage of this beautifully, and then I'll be explaining more of this in the subsequent video. I believe you have learned something new. Do not forget to like, share, and subscribe to the channel.